Welcome to Citrin Cooperman's Corner Chats. I'm Peter Katz of Westfair Communications, publisher of the Business Journal, westfaironline.com, news at noon, and electronic newsletters to keep you fully informed. Today we'll be chatting with Danny McGuire, who's an audit partner in Citrin Cooperman's financial services practice. Now, Danny has extensive experience in serving clients in the financial services industry with a focus on broker-dealers, hedge funds, and private equity funds. Danny has extensive knowledge and experience in technical accounting matters such as financial derivatives, SEC reporting, and other complex accounting transactions. We'll be examining Citrin Cooperman's new Emerging Managers Survey report. Welcome, Danny.
Good afternoon, Peter. Thanks for having me.
Now, Danny, this Emerging Managers Survey report, let's begin with a quick explanation as to what it is, what's the idea behind it, and how was it put together?
Great. Well, thanks, Peter. Again, so this is our inaugural Emerging Managers survey that we issued about a month ago. We surveyed industry participants primarily focused in the private equity and venture capital space. We felt it was important to go out and get their opinions and views on several topics. Those topics include capital raising, the fees and the terms of the funds that they're opening, talking about cybersecurity. So those are three main topics that we went out and surveyed approximately 100 respondents to get their views, their thoughts, and what is kind of important to them in the market right now. What are the issues that they're dealing with in those topics I mentioned?
Is it unusual for people in the financial services industry to be open with some of the business that they conduct to talk about the various issues that they face? And how significant is it that Citrin was able to put this together in a report?
Well, the significance of it takes time. We want to make sure that we've got enough respondents so that the reporting does make sense. If you have too few, you're not getting a broad spectrum of what the industry is considering, what they're thinking. So we do try to get at least in that 100 range for it to be meaningful. In terms of the sincerity, again, everything that we do in reaching out to these respondents is confidential. We're not sharing any of their responses with the industry per se. Obviously, the poll results are shown, so people have an idea what the respondents are from a poll perspective, but they don't know which fund is specifically responding to and indicating what their concerns, their issues, what hurdles that they're dealing with.
Now, you're very active in the field. When you looked at the results, were there any surprises that jumped out at you?
You know, after going through the pandemic, we wanted to get some insight as to what's really changed. And I think nothing so much has really changed that would really truly surprise us. For example, we always have found over the years that fundraising is always a difficult arena for emerging manager funds, right? So the newer funds to gain access to capital. That's always been difficult. It continues to be difficult. I think after the pandemic, when a lot of these capital sources kind of closed their checkbook, for lack of a better term, I think funds were hoping that as we came into 23 and even early to 24, that the checkbooks would open a little bit more. We're still seeing that it is quite difficult to raise capital in the environment that we're in. So there was nothing too surprising there. I think from a cybersecurity perspective, again, that is something of hot topic. It continues to be a hot topic and will remain a hot topic for the time to come as technology just becomes more and more important, and the risks thereof of these portfolio companies and these funds. The fees at a high level were somewhat consistent with where where they have been with past practice. So all in all, nothing too surprising.
And what were some of the specific results that you can talk about? How were things going in the industry in general when it comes to raising the capital? How are things going when it comes to defending themselves against possible cyber attacks, and so forth?
So from a capital perspective, as I mentioned, raising capital is always difficult. What the results did show, though, is where are these emerging managers receiving their sources of capital? 70% of the respondents had indicated family offices. What was one area where they are able to receive capital and have been lucky with. 64% responded that high net worth individuals is a good source of capital for the emerging managers. They all did indicate that as they become more mature, that they're more likely to obtain capital from more institutional investors, such as pension funds, insurance companies, and university endowments. But considering this was focused on the emerging manager forum, they recognize that family offices and high net worth individuals are going to be the sources of capital for them. Now, as I mentioned, fundraising is challenging. And one of the questions that we did talk about within there was that 35% of private equity and venture capital respondents have applied for and obtained certain emerging manager allocations. Now, 35% is not a big number. On the flip side, 33% have applied but not received any allocations. So you can tell that when you're only getting 1/3 of the applicants receiving money, it is a very tough environment. Now, there's some high hurdles that these managers are, those that are allocators that have high hurdles and prerequisites around how they're going to and who they're going to fund. Sometimes it might have to do with assets under management level. Sometimes they're going to be looking at track record. They're going to be looking at individual strategy of the fund. Now, does that strategy complement the portfolio that the allocator is looking for, or is it a new niche environment that the manager has never invested in and might be a good opportunity for his portfolio to invest in this fund? One thing that we did hear consistently was the due diligence process is very cumbersome. So the funds, when they do reach out to potential investors, it's not one phone call that they're having. It's a series of phone calls. It's a series of questionnaires. It's a very, very tedious and cumbersome due diligence process that sometimes lasts, months or even a year at times, before an allocator will actually write a check and invest in a specific fund.
Danny, what you're describing is an industry that sounds as if it's pretty tough and takes a lot of effort to succeed in. The money just doesn't grow on trees.
That's absolutely right. It is a very, very difficult industry for emerging manager fund. As I indicated, one of the poll results that we had, we asked the emerging manager funds, how many meetings did they have with potential investors, before closing their most recent fund? That is pretty alarming when you're and I'll give you these numbers. 19% took anywhere from 1 to 50 meetings. 19%, again, between 51 and 100 meetings. 24% had 101 to 150 meetings. 14% had 150 to 200 meetings. And 24% of funds had over 200 meetings with potential investors before they closed on their first fund.
That's an astounding piece of information. And I wonder if people realize that, when they're dealing in the financial industry,
Yeah.
whether they realize just what's involved here.
These emerging managers generally do. It's normally an emerging manager is somebody who's worked at a fund. Generally, is somebody who's worked at a fund previously. They've worked for a portfolio manager at a larger fund, and they want to go off and start their own fund. So they'll have a very good sense of the difficulties, the constraints, the time it's going to take for them to really get going. But there are strategies that do help from an emerging manager, right? So there's strategies that emerging managers responded to themselves to say, okay, what's worked well for them? So 76% of managers said that having a niche investment strategy is very important. In other words, if you have a very common strategy where you've got 100, 200, 300 competitors who are doing the same strategy as you, it's going to be difficult to receive capital with that amount of competition that exists in the market. Whereas if you have a very niche investment strategy, well, you might have a better success to getting to an allocator and having them invest in your fund much more quickly, because there are less of you out there and they can focus on you, and you might have something very particular that an investor wants. Other factors, which seem plain vanilla but are extremely important, are your marketing materials, your pitch book. How well can you describe your strategy to a potential investor? Have you looked at not only the positives, but what are the risks? You got to be open with your potential investor. The more open you are, the better chance you're going to have. Another thing is your firm infrastructure. Emerging managers generally have few employees, yet there is a cost to opening a fund and trying to raise that capital. Those fund allocators are going to look for an appropriate infrastructure. They want to make sure that you have the appropriate firm personnel. Do you have an appropriate IT manager? Do you have an appropriate legal counsel? Do you have an appropriate fund administrator? They're going to look at all of that, and they want to make sure that you have considered it, that you've engaged the right people, so that investor is going to feel comfortable investing in your fund.
Did you learn anything as to whether they're having trouble attracting talent in the industry?
The one positive thing that emerging managers can use, it's positive, but it can be a detriment too, is there are a lot of third-party service providers that a fund manager can initially use, right? So there's fund administrators who are going to take care of all your books and records, right? You can hire third-party consultants to be your CFO, either on a part-time basis. You could have them on a full-time but generally maybe it's a part-time to start, just to get enough of the funds to be able to run an actual fund with full-time employees. So you do have the opportunity to have third-party consultants to help you get through there. And again, if you have the right people in place, it shouldn't deter the allocators from providing you with capital.
Getting back to cybersecurity for a minute, did you get a sense in the results of the data that was collected that firms actually are paying attention to cybersecurity and are being proactive when it comes to their computer systems, their technology, and
yeah? So the short answer is yes, Peter. It is, as part of the due diligence process to which allocators are doing, it is a critical part of that due diligence process. When we went out to the respective funds to inquire of what they do from a cybersecurity process, 63% of respondents say they use an external IT resource. 24% indicated that they've hired somebody internally, so they have an internal IT resource. 12% actually indicated they have a dedicated internal cybersecurity resource. And one surprising fact is 15% said they didn't know. So to answer your question from earlier about any surprises, the 15% who said they didn't know about who's the firm cybersecurity resources, that is a little troubling because of the importance of cybersecurity in today's environment. And again, the allocators who are providing capital are going to be all over that. If you answer, we're not sure who that is, you're going to lose them at the table right then and there.
What can you tell us? What can you tell us about the size of these particular funds that responded to the?
So the size of the funds are going to range. So again, we're doing with emerging managers, so we're going to deal with the smaller ones, the startups. 58% of the respondents had $150 million or less of assets under management. 19% had $150 to $250 million in assets under management. And then we had about 20% of greater than $250 million in assets under management. In terms of the number of employees, that ranged. We had 47% had less than 5 employees, 23% had anywhere from 6 to 10, 23% had 11 to 15 employees, and 7% had 6 to approximately 50 employees. Now, obviously, the smaller firms, those with assets under management of less than $150 million, are going to have less employees. The more mature, the more complex, the more funds that a fund has will then start having more employees as well.
And how open were the respondents in discussing the fee structure that they have and the size of the fees?
They were very open on that. We did talk about, had some questions around the fees. We wanted to get a sense of if things have changed over the last decade since the pandemic. Have things changed? So when we went to talk about fees, 74% of respondents indicated that they charge a 2% or more management fee and have performance fees that are about 20%, which is fairly consistent in the market. What you do often see, though, with emerging managers is oftentimes they're willing to provide a so-called accommodation to a seed investor, right? So if you get a new fund and somebody's willing to give you $25 million, $50 million in seed capital, you're willing to give them an accommodation of a discounted management fee, for example. And so instead of charging them 2%, you may charge them 1%, 1.5%, because you know how important it is and how difficult it is to get that initial source of capital.
And what were you able to learn about the returns that these funds were able to provide? Were they promising particular returns to the investors, or was that a subject that they just wanted to keep under the vest?
So we didn't get too much into the return aspect because no fund manager will promise any specific return on any fund. It's something very difficult to do, especially within the private equity and VC space. That being said, often track record is very important when trying to attract capital. So the fund managers of these emerging funds will have, very oftentimes they have track records that they will provide to potential investors so that they can prove that they are a valid and good source for them to obtain a potential return on their investment.
Were you able to get any sense as to how people in the industry feel about the industry? They happy with it? They find it exciting? Are they attracted by the challenges? Just what is it that draws people into the industry, and how do they feel about what they're doing?
Well, Private equity and VC in the last, I'll call it 5 to 7, maybe 10 years, has really grown. The alternative investment space started out with hedge funds, earlier on, and that was the big player. But over time, we have seen a greater opportunity for private equity and venture capital funds to be successful. The individual players in that market are those who clearly from a general partner perspective at these emerging manager funds are those with years of experience. They've either come from the investment banking space and or other private equity shops to create their own fund. These are individuals who know the industry. They know the difficulty of attracting the capital. They know the so-called blood, sweat, and tears it's going to take to be successful. Each one of them has their own, kind of niche in terms of what they're good at and what they're going to bring to the table for a potential investor. So,
before we continue discussing this, we should let people know how they can see a copy of this report.
Great.
I assume it's available to everyone. You don't have to be a Citrin Cooperman client in order to
Absolutely not. This is a public document that we did post on. We have it on our website, citrincooperman.com. And if you go into the In Focus Resource Center, you will find all of Citrin's surveys and reports that we've issued. So it'll be in there. An easy way to do it as well is if you just Google search Citrin Cooperman Emerging Manager Survey. I believe the first link that will pop up will bring you right to the survey itself. And Peter, as you indicated, it is available to anybody.
In doing this, was the result such that you've decided that this is worth doing on an annual basis or repeating it sometime in the future?
We definitely will be doing another one. Whether we're going to do it on an annual basis or biannual, we're still determining that. But we do find that there's value in this to provide some insight into what individuals are thinking, and also obviously attracting, from our perspective, inquiries from potential clients or clients of ours that have maybe some questions on it. Sometimes we can introduce people to each other, and that helps as well.
Just who would be interested in this report? Any business person? Would you have to be an investor, or would you have to be in the industry to be interested in the results of the information that you've gathered here?
I think it's a number of individuals who would be interested. As you indicated, it's going to be the allocators, those who are investing in these funds, the fund managers themselves, the emerging manager. It's always good for them to understand what their peers are thinking. Oftentimes, they might assume that they know what they're thinking, but to actually get a survey of such that has 100 respondents in, it gives them a good indication of where others might be having difficulties. Are they consistent with them? Are they doing something different?
So, Danny, what can we glean about the future of venture capitalism based on some of the information you're able to pick up from this report?
Well, I think from an industry outlook, you've got private equity and the venture capital firms. They're still recovering from the effects of the pandemic through inflation, the interest rate hikes, and the macro uncertainty that existed. Higher borrowing costs have depressed deal volume, exits, and fundraising. As a result, exit activity, remains at a unprecedented low volume relative to the assets under management within the industry. I think at the time of the survey, about 64% of the respondents were concerned about a possible recession or market turbulence in 2024. Again, this survey was conducted in December of 2023 into January of 2024. We're now 6 months later. I think some of those concerns have calmed down a little bit, yet there is still market turbulence from an industry perspective. By the end of the year, by the end of 2024, the outlook does begin to improve. Their expectations are that inflation will begin to cool. Their hopes are that the Fed has started or will begin starting to cut interest rates. They do anticipate fundraising in 2024 and into 2025 to remain difficult. They're hoping it will become easier. However, they do see some positivity that will be coming out and optimism over the longer term. Again, if interest rates are cut later into 2024, it will help the exit prospects. There will be a loosening of hopefully the limited partner purse strings. So as long as an emerging manager has a strong team, as their well-articulated strategy, they should be in a good position to take advantage of some of the improved market conditions and a better fundraising environment.
And was anything said by the respondents regarding government regulation? Now, presumably, it's no picnic filling out SEC paperwork all the time. But was there any thought given to either the value of government regulation or the difficulty of government regulation?
Well, there definitely is more remarks around the difficulty of regulation. At the time that we issued the questionnaire, there were potentially new SEC private fund rules that were going to come into play that were going to be extremely burdensome to smaller funds, such as these emerging managers. However, since the timing of our report, there were industry participants who were suing the SEC to say that these rules were an overreach of the SEC's authority. And as a result, the courts did agree with that. So those private fund rules, as of today, are no longer going to be required to be implemented by the funds.
And one more time, can you give us how to see the report and who can see the report?
Absolutely. So the report is publicly available. There are two ways you can see the report. One is to go to citrincooperman.com, go into the In Focus Resource Center. That will have all of Citrin's written reports, surveys, results of surveys included there. Additionally, you can also Google Citrin Cooperman Emerging Manager Survey, and that should bring you to the first link, which will bring you to this survey report.
And Danny McGuire, thanks so much for being with us on this edition of Citrin Cooperman's Corner Chats. I'm Peter Katz of Westfair Communications.
Thank you, Peter.